Hey, Jeff Carlisi here from 38 Special, and we're rocking it up right here with Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have back with us once again David Scranton. He's CEO and founder of Sound Income Strategies and author of Return on Principle, 7 Core Values to help protect your money in good times and bad, right? David, welcome back to Traders Nation. How are you today?
I'm doing great. How are you?
Doing awesome. Thanks for being here, back with us once again. Hey, it's said that the Fed rates, the Fed may hold these rates, or may even go lower, if you will, but they've also indicated, David, that they're shocked that inflation is so low. Why is that?
Well, I'm really not surprised that inflation is low.
Yeah.
In fact, I was on television talking about that when, they actually started raising rates for the first time a few years ago.
Yeah.
And my comment right after Janet Yellen's announcement was simple. It was, well, if we've held rates this low and we can't stimulate the economy enough to create inflation, then how the heck are we going to raise interest rates and stimulate the economy enough to create inflation? Because here's the bottom line. We have a whole generation right now of people that got skunked twice by the stock market and once by the real estate market since the turn of the century.
Sure.
An aging population, a lot of boomers, who are taking whatever additional money they have, and they're not necessarily spending it and stimulating the economy. Instead, they're taking that money and they're using it to pay down debt, to save and invest, and so on. Yeah. And that's great for their own personal financial stability, but it's not so great if your goal is to stimulate the economy and create inflation.
Sure. That's interesting because I think by what you're saying and what I'm hearing is that maybe this time we actually learned that all that debt is like an anchor to us financially, right? And the sting of the market, which hit us twice, and certainly, like you said, the housing bubble was damaging beyond some people's imaginations. Some markets as low as 50%. I know here in Phoenix it was 50%, in Nevada and 50% down in market. So people never thought this could happen to them when in fact that it did. So, I get what you're saying that, the economy needs to recover, and certainly some would think that, but certainly the people are now paying down their debt. Are they being a little bit more financially responsible for their own household and finances, David?
Well, they are. And, at the end of the day, that's really a good thing. Because first of all, an aging population tends to spend less. It's just, it's not about stuff anymore that you can acquire. It's about other things. So that's part of it. And then with the experiences they've had, as close to retirement as those negative experiences actually came, they've realized, we need to be careful now. We need to be prudent. So it's a healthy thing. But you see, the real issue is that the Federal Reserve, the government, has been trying to artificially stimulate the economy for a long, long time now.
Right.
It really started in the 70s when we went off the gold standard, but it took a little while. But if you think back even to the 1980s, the first liar loan, the first liar mortgage, if you will, was in the 1980s, when you can literally say, gee, if I put 30% down, I make $17 million a year, and they never checked it.
Right.
If you also remember, that was about the time that we first started taking on automobile leases, where all of a sudden people started to think, well, maybe I don't need to keep my car for 10 years. I can get a new one every 3 years.
Sure.
So what that's done is that created an artificial demand for goods and services.
Right.
And then the Federal Reserve, the government, created fancier and fancier ways to stimulate that demand artificially, and the bubble just grew and grew and grew. And now that bubble of economic demand has burst, and it's harder to keep it afloat now, and that's why we're struggling to get GDP just at 2%.
Right. It's interesting because the criteria for all those things you said, for housing certainly, for cars you literally can go in and drive out with a car, right? Almost at any amount. Right. And the criteria. So when everything hit really hard. All the lending institutions, they tightened up their criteria really bad. Some people with 800 plus credit scores actually lost credit lines that they had. For instance, I had American Express. I had a $50,000 line of credit with them. I had about an $8,000 balance with them at the time. It was business loan. And instantly, they sent me a letter during this crunch, and they said, hey, your limit's now to what you owe us. Right? So that's how they contracted so much. And I was not a risk at all, still not a risk, probably the best money that they'll ever make. But they did that, right? So now we're starting to see some of that criteria loosening up a little bit. Are we going to fall back into those traps when it comes to housing and cars that you're thinking of?
Well, we'll see. I mean, there is some concern about, subprime car loans.
Yeah.
That's, and I don't have the numbers to know whether or not that's a more systemic problem, perhaps, than the mortgage crisis was back in 2008.
Right.
As far as real estate, though, I don't think we've gotten back there. We haven't gotten back to where we were in 2008. We haven't loosened up to that degree,
right.
Thankfully.
Yeah.
So we might see it in the area of car loans.
Right.
That could be an issue. We know we're going to see some defaults on student loans and things like that.
Yeah.
But again, I don't really see it necessarily with real estate.
Okay.
You see it in other areas.
Yeah. Are the Feds still printing money like they were? I remember back during the housing bubble, man, they were basically printing it until they were going to run out of ink. Are they still printing money like that, or are they contracted in the printing of money?
Well, it's interesting. It just flipped again a few weeks ago because they were actually reversing. I mean, of course, they're always printing money because our debt is growing and running a deficit. But they were reversing that quantitative easing that they had done back in 2008, 2009, and right through 2013. Because they're actually now, instead of buying bonds back, they were selling some of those bonds, reducing the Fed's balance sheet.
Okay.
And that's a contractive policy, but they just came out 3 weeks ago, and the Fed said, we are going to discontinue that practice gradually between now and September.
Yeah.
So that's really another loose money policy. Now that doesn't mean they're going to start QE, but by stopping the reversal of QE, they're going in the same direction.
Yeah, almost.
And again, that's because they see the economic signals, and they're concerned. They don't want to tighten anymore.
Any concerns about the flattening of the yield curve?
Yes. It's been a big concern of mine for a long time.
Yeah.
And I think the biggest thing in that message from the Federal Reserve just a few weeks ago that really shocked me was that, they've been trying to raise short-term rates. And I'm concerned that short-term rates going up is going to flatten the yield curve, right? Well, they stopped that in December because the bond market basically stood up and said, enough is enough.
All right.
So when they came out 3 weeks ago and they tried to lower the long-term end of the yield curve, it's almost like they're creating a flat yield curve. If they can't do it one way, they're going to do it the other way.
All right, we're out of time.
Have another Fed-induced recession.
David, we're out of time. Get a copy of David's book today, Amazon. We'll be right back. Welcome back. You are tuned in to Traders Nation. Boy, Don, we came right up against that hard break, right? Head on over to Amazon.com or your local bookstore. The guy in the corner needs your money, too. Support and all that good stuff. Get a copy of Return on Principle, 7 Core Values to help protect your money in good times and bad. Great book, man. Some awesome information inside here. Get a copy today.